occur. And we had on that particular day, that was on January 20th, we had the predicted low of 1138, so that would make your target at 1128. Again, the same type of thing that we did before. If you have a target at 1128, you're going to be short right in here somewhere, and you are going to be collecting some, excuse me, I should take that one away. So we're going to sell at 1128, and that particular point is roughly right in here. And then we're going to help or ride that down, and we're going to set our targets at 1108, and 1108 occurs about right in here, and then we're going to ride it down 1088 and set a target right here of 1068. Now we can also, as I mentioned before, we can determine if we want to take this profit at 1068 or if we want to ride it a little bit further. But if you took it with the 3 contract situation, you have pocketed a pretty nice chunk of change if you ride the E-mini down this far. Again, after the market has moved down and you are short on this candle right here, you have the predicted high of right there at that particular high. You'd have a predicted high, and that's at 1084. So at plus 10 at 1094, you're going to get out of that contract, and then you're going to be sitting flat on this contract. You're going to be out of the market. As after this trade, the market then does turn back around again. We have a, it's the type of thing you have to watch this every day. Kind of download your data every day, kind of make your decisions, make your plans, your trades, as to what can happen. On this particular day, we had the predicted low of 1088, so we have our selling target at somewhere around 1078, somewhere right in there, and we're going to then set our target 1058, and I believe 1038, and I believe we did just barely catch that with that second one. But then the third contract, as we happened before, we would probably have to keep our stop above this predicted high right here, and would probably have gotten stopped out somewhere in the vicinity here where we would have gotten out of the market and now be kind of sitting sideways, depending on what to do. Now, it depends, again, a little bit on how you view the longer-term picture and the shorter-term picture. There's a possibility that, in this case where you could have a breakout either side of the range, you could trade, on a contingency basis, buy the breakout on the upside or the downside, whichever, using the other breakout as a stop. Again, the range here is fairly wide. You can see it's getting close to 20 points, and 20 points is maybe a fairly hefty size of risk for you to take. 20 points actually plus the 10 points that I mentioned leeway on either side. So where you place your stops and so forth will depend upon how much risk you can tolerate and what you want to think. I will point out that when you look at what is going on in the market currently, what it looks like is that shape heading up going into today, and today was, at this point anyway, was a fairly strong move the last I saw. But we had the predicted differences pointing up. We had the Darrell index at 1, so that would suggest that your odds, your probability, would favor being on the long side for a breakout for this particular market. I'm going to switch back over here to our Vantage Point screen, talk about a couple of other markets, and kind of do a quicker analysis of them and see what would happen with the breakout situation if we were to trade with that particular type of a strategy. The next market that we're going to look at, the euro. Euro, very popular currency to trade, as you know. There's a great deal of discussion about the value of the U.S. dollar, and the euro is kind of the counterpart, or the contra dollar, or whatever you want to call it, because it's a mirror image of what the dollar does. So what the dollar does, what the euro does, those are very important gauges of what the whole commodity market situation might do, simply because as the dollar gets higher, the likelihood of other commodities being under pressure is increased. So that's why the currency should be a factor in any market that you trade, and one of those that you need to watch. On the euro, we'll not go through the whole point here of showing all the trades, but you'll see right where the cursor is right now that was a good breakout situation for the euro. The predicted low was at 144.48 that particular day, and so that meant you would have been into the market. You would have been making a trade at 143.48. Again, that's a full 100 points, 100 pips. You may have another guideline that you want to do depending upon how much risk you're willing to take, and kind of like you have to watch the market, you have to watch what the previous range has been, daily range, and then use that as a guide in setting up where you might possibly want to, how much you want to allow the market to move up and above the predicted high or below the predicted low. In this particular case, we had the euro trending all the way down until you get to this white candle down here towards the bottom. We start to get a little bit of a turn in the situation, a bottoming situation, and we had the predicted high exceeded by the full 100 pips, and so you would have been out of the market, and again you'd be sitting there on the sidelines. You potentially could have gotten short. If you'll see here where this predicted low was, where the cursor is, you potentially could have gotten short at 100 pips below that point on this particular candle right here. But if you look at it from the standpoint of where the next possible move is, you're probably going to be looking at some kind of a move above the predicted high as an entry situation. No good signals yet from the predicted differences or from the neural index or anything. We need another day of trading, and of course we have it by now, but at the time I made this chart, going into the week or after the weekend and the holiday, that's what it looked like. You would need another little boost of trading if you were to keep a stop above the predicted high for that to be reached. One final market that we're going to take a look at to see kind of how it looks, because it's a popular one also, and that is soybeans. The soybean market is a favorite in terms of speculators because it has quite a bit of movement and sometimes fairly volatile movement. If you go back, time, you'll know that in the case of soybeans, there's kind of a contra-seasonal move in the fall. Then we have a situation that has been dubbed as, probably if you've traded grains at all, you know about the February break, the so-called February break that occurs every year in the early part of the year. And so that's kind of what the market has been going through recently. But stepping back a little bit just to take a look at some of the movements in the soybean market and what has occurred. The first thing that you'll note is that we have a situation back a ways here where you had the predicted high of, let's see, what we have, 1008. So that means that, again, I'm using 10 cents here as my point of leeway simply because 10 cents equals $500 in a full-size soybean contract. I like $500